Here's a question for you. What's the one problem that condo associations and marriages have in common? The answer? Money management. Ultimately, both are significantly influenced by financial decisions. Just as in a marriage, in a condo association, monetary problems are often the most challenging, affecting both the association and the unit owners. Hello, and welcome to the All About Condos channel, your go-to source for all things condo related. Brought to you by Ickman's International Realty. I'm your host and condo consultant, Octavio Rueda, here to guide you effortlessly through the challenges of buying and owning a condo. In this video, we're diving deep into 8 key financial documents that reveal how condo boards and management use the association's funds. I'll guide you through how these financial documents are utilized by condominium associations to monitor and control their assets and liabilities, and I'll provide insights on how to review and understand them effectively. Because there's so much valuable information to cover, I've decided to split this content into 2 parts. In part 1, we'll focus on the first 4 key financial documents: the operating budget, the reserve schedule, and the 2 income statements. In part 2, we'll dive into the remaining 4, the balance sheet, cash flow statement, accounts receivables, and accounts payable, along with the explanation of cash and accrual accounting concepts. Understanding these financial documents is crucial for both unit owners and prospective buyers. If you're a unit owner, it's about ensuring your fees are being properly utilized. For both first-time home buyers and experienced investors, understanding these financial documents is crucial in evaluating the soundness of your investment. As you might know from my other videos, I'm not an accountant. However, my years of experience as a Florida Condo Association manager have given me a comprehensive understanding of the condo financial documents I'll be presenting in this tutorial. My goal is to share this knowledge with you, breaking it down simply and clearly for easy understanding. And although my specialty lies in Florida condos, the accounting principles we'll discuss, such as the accrual and cash basis accounting, are universally applicable to condo associations. Therefore, the insights I share today are applicable to any association employing these methods, regardless of their location. That being said, let's get started. A condo association has core obligations and responsibilities to its unit owners, including maintaining the integrity of the building structure and common areas, ensuring unit owners' rights to peaceful enjoyment of their units, and maintaining a good quality of life for all residents. The financials of a condominium association provide a comprehensive overview of the association's financial health and performance. These documents reveal important information such as sources and amounts of revenues generated by the association, as well as those revenues that are spent. Additionally, financials are used to estimate the association's financial needs on a yearly basis in order to sustain its operations. To accomplish this, there are several financial documents that are used, including the operating budget, reserve budget, income statement, balance sheet, cash flow statement, and accounts aging reports. These documents work together to provide a clear picture of the association's financial standing and future projections. Understanding these financial documents is crucial for making informed decisions to ensure the long-term financial stability of the association. These financial documents and reports are generated by the association's accounting department, and with the exception of the budgets, are typically generated at the same frequency as the regular maintenance payments. For example, budgets are prepared annually, and the other financial reports are typically generated monthly, quarterly, or on an as-needed basis. In Florida, the condominium law requires that the association's financial reports be compiled, reviewed, or audited by an independent certified public accounting firm at the end of the year to ensure that they are in order. Now let's go over each of the most commonly used financial documents. Let's start with the operating budget. A condominium operating budget is a financial document that outlines the expected income and expenses of a condominium association for a specific period of time, usually 1 year. The operating budget is created by the Condominium Association's board, management company, or an independent accounting firm hired by the association. Each year, a draft of the following year's proposed budget is reviewed and adopted by the Board of Directors at a duly called meeting. The adopted budget serves as a guideline or as a point of reference for managing the association's finances to ensure that the association can meet its financial obligations and provide the necessary services to the unit owners. The operating budget for a condominium association is typically prepared using the equation operating budget equal revenues minus expenses. Reserves, if included, are usually a separate line item and are not factored into the net balance of the operating budget. However, in Florida, condominium associations are required by law to have a reserve fund. Consequently, the operating budget is prepared or formatted using the equation operating budget equals revenues minus expenses minus reserves, taking into account the necessary contributions to the reserves as mandated by Florida law. So in Florida, operating budgets have three main sections: revenues, expenses, and reserves. Each individual reserve or expense category listed in the budget is referred to as a line item. The line items will vary from condo to condo, primarily depending on the condo size, assets, and amenities. The association's revenue stream is primarily composed of the amount collected from regular assessment fees and special assessments, if any. Other sources of income may include late fees, rental income, purchase and rental application fees, laundry income, transfer fees, and surplus income from previous year's operations, if any. As you can see, the bulk of the association's income will always come from regular assessment fees paid by unit owners. In terms of expenses, the association's yearly budgeted expenses will vary from one association to another, but you can expect to find several expenses that are common to all condominium associations, which are generally divided into the following categories: administrative, maintenance and repairs, utilities, other expenses, and reserves. Some example line items found under administration expenses are accounting, bad debt, insurance, legal, licenses and taxes, management fees, office, supplies, and postage. Under maintenance and repairs, line items are buildings, elevators, fire systems, grounds, supplies and tools, swimming pool, clubhouse, laundry, and miscellaneous. For utilities, we have electricity, sanitation, water and sewer, telephone and internet. Other expenses line items can be pest control, security, operating capital, special enhancements and contingency. Reserves is a portion of the overall budget that is set aside to cover future major repairs or replacements of common elements within the condominium complex, which are commonly referred to as deferred maintenance and capital expenditures, such as roof replacement, building painting, pavement resurfacing, elevators, pool, and clubhouse. And I will go over these reserves and other line items in more detail in the next section in a few minutes. The net results of the total revenues minus total expenses minus reserves should ideally be zero. So we have revenues of $380,100 minus expenses of $340,600 minus reserves of $39,500 equals zero. Note that if the number is within parentheses, it means a negative number, which means a loss. If you're wondering why the balance in a condo association's operating budget is zero, it's because condo associations are not-for-profit corporations whose primary purpose is to manage the condominium on behalf of its owners and members. They are not supposed to generate profits for its members. Most condominium associations prepare the budget for the new year by estimating a fixed amount or a percentage of a possible increase based on expenses in previous years, if any. So when preparing the budget, the goal is to estimate as closely as possible the projected operating expenses for the new year and check that there are going to be sufficient revenues to cover the projected expenses. No more, no less, and therefore the net income should be zero. So the operating budget is basically a roadmap for the condominium association's finances over a certain period of time. It's a pretty important document that helps the board manage the association's finances responsibly and ensure that there are going to be enough funds collected from the unit owners to cover all the expenses. In other words, a well-planned budget is key to keeping things running smoothly. For a condo association, running smoothly means no sudden increases in regular assessments or major special assessments. Therefore, the operating budget is important as it is used to determine the maintenance fees unit owners will have to pay for the budgeted year. But here's the thing, budgets on their own aren't really all that useful, to be honest. You need to review it regularly and compare the projected income and expenses with the actual figures reported in the monthly or quarterly income statement. That way, you can make necessary adjustments to the budget and keep the association's finances on track. This is done using an income and expense comparative report, which basically combines the income statement and budget. I'll show you how the report works after we discuss the income statement. So let's move on to our next section, the reserve schedule. This is what a reserve schedule looks like. Due to the long-term nature of the maintenance and replacement of the reserve items, associations account for the collection of the set-asides in the operating budget and use the reserve schedule to track the estimated total cost and useful and remaining life of its amenities, service equipment, and capital improvements whose repair or replacement is expected to take place and be funded in the long term. In Florida, there are specific requirements for a condominium association's annual reserve budget. The budget must include costs for roof replacement, building painting and pavement resurfacing, and any other repairs or improvements such as elevator repair and modernization, pool resurfacing and improvements, and clubhouse roof and remodeling that could cost more than $10,000 to fix or replace. These are the same reserve line items and set-aside amounts, expenses, that we saw on the reserve section of the operating budget. Generally, an engineering firm's reserve study is used to create the reserve schedule that estimates the useful life and replacement cost of these items. The goal is to regularly set aside enough money to ensure that there are enough funds available to pay for these expenses when they come up, without having to rely on special assessments or loans from a bank. Let's take a closer look at the reserve schedule. The format of the schedule may vary depending on who prepares it, but typically it has 6 columns. Column A lists the reserve items. Column B shows the estimated total useful life. Column C displays the estimated remaining useful life. Column D indicates the estimated cost for the deferred maintenance or capital expenditure. Column E shows the estimated fund balance as of the end of the budget period. And column F displays the funding requirement for the proposed budget period. The figures in column B, C, and D are generally estimates provided by a reserve study or engineering firm's evaluation of the reserve items. On the other hand, the figures in column E and F are calculated by the association's accountant. Column E represents the fund balance, which is defined as the sum of the money saved or made available for the reserves. This column shows the amount of money allocated by the association for reserve items up to the end of the budget period under review. To determine whether the reserves are being properly funded, we can use a formula using the column labels B minus C times F equals E, where we have column B, estimated total useful life, minus C, estimated remaining useful life, multiplied by F, funding required for the proposed budget period, equals the E, estimated fund balance as of the end of the budget period. So in this example, the mathematical expression is 20 minus 5 times 16,000 equals 240,000. So 20 minus 5 is 15 times 16,000 equals 240,000. And there you have it, a properly funded roof replacement item. It's worth noting that having a reserve in the budget doesn't always mean that the association is funding it. You should always check your balance sheet for the estimated fund balance and funding transactions. All the operating and reserve transactions, the money applied towards it, and the fund balances should be reflected in the balance sheet. The reserve fund balance should be listed as a line item in the assets section, and the periodic budgeted amount should be listed as a line item in the liabilities sections, along with the amount being applied towards it each accounting period. I'll show you where to find the information when we get to the balance sheet in a few minutes. In Florida, unit owners have the power to vote on whether to partially or fully fund the reserve for the year during their annual meeting. This means that the amount a unit owner pays towards the reserves will depend on whether the reserve is being partially or fully funded, as well as the unit owner's prorated percentage of unit ownership as determined in the condo documents. So it's important for unit owners to be aware of the funding level of the reserve and their share of the cost, as it will affect their assessments. Based on my experience, it's not common for condo associations in Florida to fully fund their reserves. However, there's a possibility that this trend might change soon. Currently, the Florida legislature is discussing the implementation of a new law that will require condominiums to set aside money for their reserves. If passed, it could be a significant change for Florida condo associations and could potentially have a significant impact on their finances. Associations would need to carefully review and adjust their budgets to ensure that they're in compliance with the new law. Additionally, owners will surely see an increase in their assessments to cover the newly required reserve contributions. For those of you who don't live in Florida, you can check out the link below to learn more about the reserve requirements and funding for all 52 states. And if you live outside the U.S., make sure to check with the condo laws in your country. Many unit owners may choose not to fund the association's reserves to avoid paying additional maintenance fees. However, not funding the reserve can be a short-sighted decision, what is commonly referred to as being penny wise and pound foolish, because eventually major repairs or replacements will need to be made. Not having a reserve fund may also make it difficult to secure a mortgage for a unit in the association, which can affect the marketability of units when they are up for sale. It's worth considering the long-term effects of not funding the reserve and whether it's worthwhile the decision for an association and its members. By not funding the reserve, the association may be setting itself up for financial difficulties in the future, which can result in special assessments or loans from banks, which can be even more costly in the long term. In contrast, funding the reserve can provide a sense of financial security, reduce the likelihood of unexpected expenses, and help maintain the property values in the association. It's essential for both the board and the unit owners to understand the importance of funding the reserve and the potential consequences of not doing so. Now that we've discussed the condo operating budget and reserve funding, let's move on to another essential financial document for condos, the income statement. Our discussion of the income statement is going to be brief because you already know a lot about the income statement since we discussed the operating budget in detail. The income statement is used to show the association's actual revenues, expenses, and net income or loss for a specific period of time, typically a month, a quarter, or a year, using the same accounting formula as the operating budget, which is revenues minus expenses minus reserves equal net income or loss. In fact, in terms of format and line items, the income statement and operating budget are identical. The only difference between them is the space their information occupies. In other words, the income statement's data is in the past and the budget data is a projection of the future. The income statement provides information on the income and expenses that have already taken place, whereas the operating budget information is an educated guess of what will be earned or spent in the near future. To help you visualize the similarities between the operating budget and income statement, let me show you how quickly and easily an annual operating budget can be transformed into an income statement for the month of January. Let's assume we're doing this transformation of the operating budget in mid-February. This is going to be quick, so pay close attention. First, I'll replace operating budget with income statement and remove the subtitle, leaving only January 2020X. Then, I'll remove the annual estimated income and expense projections and replace them with the actual income and expenses for January. And just like that, we have the January income statement. When reviewing the income statement, the main thing to focus on is the bottom line, which shows the net income or loss similar to the operating budget. However, the bottom line can differ significantly between the income statement and the budget. Ideally, we want a positive net income, but if it's in parentheses, it indicates a negative income, which means it's a loss. A quick look at the bottom line of the income statement can show whether the association is operating within its means, meaning it generates enough money to support the building's operation and provide essential services to unit owners without the need to increase the maintenance fees or implement a special assessment. The income statement serves as a form of a report card, which unit owners can use to assess the performance of the board of directors and management in managing the association's financial resources. If the income statement has a negative balance for a given month or year, it means that the board of directors and management have not done a good job managing the financial affairs of the associations that month or year. On the other hand, if the monthly or year-end income statement shows a positive balance or surplus, then the board of directors and management have done a good job for the month or year under review. In my opinion, the board of directors should be re-elected and the management company's contract should be renewed based on the result of the year-end income statement. Well, this may seem like common sense. I've seen instances where the association has had 3 consecutive years of the same or slightly increased income, but has also had large losses, yet the same board members were re-elected. It's important to consider the association's financial conditions and performance when making decisions about leadership and management. All right, now that we have a good grasp on what the regular income statement looks like, let's take a look at how this information can be used to create a comparative income statement using the operating budget. As I said when discussing the operating budget, budgets on their own aren't really all that helpful. The usefulness of the budget is at its highest when used in combination with the income statement. The combination of the two statements, called a comparative income statement, makes for an invaluable financial assessment tool. Since we're already familiar with the operating budget and income statement, the format and review of the comparative income statement is straightforward, as it combines the monthly or quarterly income statement, depending on the association's accounting cycle, with the annual operating budget split into monthly or quarterly amounts. The comparative income statement typically includes 2 variance columns that show the difference between the actual versus the budgeted income and expenses as a net amount or as a percentage basis. Let me show you. Here we have the January income statement we prepared in our previous session. Let's first label this column our annual income and expenses. Then let's add the January budget column and 2 variance columns. The variance is typically shown as both a dollar amount and a percentage. The dollar amount reflects the difference between the budgeted amount and the actual amount, while the percentage indicates the variance as a proportion of the budgeted amount. Here's the formula for the variance. Net variance equals actual revenue minus budgeted revenue. Percentage variance equals actual revenue minus budgeted revenue divided by budgeted revenue times 100. To illustrate, let's review the total revenue, total expenses, reserves, and net income as examples. The actual revenue of the month of January was $30,878, and the budgeted amount was $31,675 for a difference of $797, which is a negative 3% of the budgeted amount that went uncollected. In contrast, the actual total operating expenses for the month of January were $27,061, whereas the budgeted amount was $28,383. Here, the variance is $1,322, which is equal to a negative 5% of the budgeted amount. It's worth noting that if the reserve is funded as per the budgeted amount, there should obviously be no variance between the two. Therefore, we can see that although the revenue for January was lower than the projected, we still have a positive net income of $525 because our expenses were less than budgeted. Had our expenses been significantly higher, we would have incurred a loss, which would be shown in the parentheses. It is not a major concern to have a loss every once in a while, but it becomes problematic if it occurs frequently and leads to a substantial loss at the end of the year. If the association's total income regularly falls short of covering all the expenses, the board has to take action. They can either raise the regular assessment or implement a special assessment to make up for the shortfall. When it comes to the operation of condo associations, there's no getting around the importance of having a solid budget in place. It's not just about plugging numbers into the budget. It's about ensuring that the association has enough money to pay for everything it needs. To create a budget that works, you need to plan carefully and pay attention to the details. A well-planned budget can be a valuable asset for the association and its members. The comparative income statement compares the actual financial performance of the association during a specific period with the budgeted or projected financial performance for the same period, which is based on the operating budget. The operating budget serves as a guide or a plan for the association's financial activities and is used as a benchmark to assess the actual financial performance of the association. By comparing the actual income and expenses to the budgeted income and expenses, the association can identify significant variations and take the appropriate action to manage its finances effectively. The comparative income statement is used to evaluate how well the association uses its revenues to fulfill its obligations and responsibilities. The net income from the operating budget can be either positive or negative. A positive net income means that the association is generating more money than it's spending, while a negative income means that the association is spending more money than it's generating. In that case, it's important to check which expense line item caused the negative result. The results of estimating the expenses for the following year's operating budget will determine whether a special assessment fee is needed to be charged to unit owners if there's any shortfall in the operating budget for any reason. Well, that wraps up our first half of our deep dive into understanding condo financials. In part 2, we'll continue exploring the key documents that reveal how your condo finances are managed. Make sure to join me for the next part, where we'll break down the balance sheet and cash flow statement and more. See you in part 2.